64%. That is how much profit Mercedes-Benz lost in a single quarter. Not during a recession, not during a war. Right in the middle of a global luxury boom, when wealthy consumers were spending more than ever on watches, private travel, and fine dining. Mercedes-Benz, the inventor of the automobile, a brand built on 130 years of engineered prestige, watched more than half of its operating profit in the passenger car business simply disappear in 3 months. The number is staggering. The story behind it is darker still. Mercedes-Benz opened its Q2 2025 earnings call with a number that sent shockwaves through the industry. Adjusted EBIT for the passenger car division had collapsed to 1.23 billion euros, a plunge of 64%. This was not a blip on the radar. It was a rupture, one that cut straight through the company's reputation for resilience. The margin for cars, once a source of pride, shrank to just 5.1%. For a brand that had posted record profits only a few years before, the scale of the reversal was unprecedented. There was no recession, no global crisis to blame. Instead, Mercedes found itself exposed in the middle of a luxury spending boom, forced to explain how a company built on exclusivity and engineering could lose more than half its earnings in a single quarter. The shock was not just financial, it was existential. If Mercedes could fall this far, this fast, what had gone wrong beneath the surface? In 2022, Mercedes-Benz reached a financial summit few could have imagined during the chaos of the pandemic. The company reported an operating profit of 20.5 billion euros, a figure that stunned even seasoned analysts. But this was no accident. Chief Executive Officer Ola Källenius stood before investors at the Côte d'Azur, laying out a vision that redefined the company's entire purpose. Mercedes would become a pure-play luxury car maker, chasing not volume, but desire itself. The new doctrine was clear. Scarcity would be engineered, not left to chance. Over 75% of research and development spending was redirected to the most profitable segments: S-Class, Maybach, and high-end electric models. Entry-level offerings were trimmed, and resources that once supported broad market ambitions now fueled the quest for exclusivity. Källenius spoke of creating objects of desire, not just cars. The numbers seemed to vindicate him. Margins soared as chips and inventory were funneled to flagship models, and the world's oldest automaker rebranded itself as a luxury house for the modern era. But the very confidence that powered this ascent would soon become the source of its greatest vulnerability. During the global semiconductor shortage of 2021 and 2022, Mercedes-Benz's planners found themselves holding a lever that most automakers could only envy. With chips in short supply, the company made a calculated decision: allocate the scarce components almost exclusively to its highest margin flagships, Maybach, S-Class, G-Class, and the new electric EQS. Production of entry-level models slowed or stopped altogether, while luxury variants rolled off the line, fully equipped and commanding record transaction prices. For a brief window, this supply-driven mix inflation delivered extraordinary margins, with the group's operating profit in 2022 soaring to 20.5 billion euros. Industry allocation reports from the period show that Mercedes, like its peers, used the chip crisis to engineer scarcity, but the effect was magnified by its aggressive portfolio shift. Yet this artificial lift masked a deeper fragility. As chip supplies normalized in late 2023, the forced exclusivity vanished. Suddenly, the market had to absorb a full range of models at real demand levels, and the illusion of insatiable appetite for top-end Mercedes began to unravel. The record profits of the shortage era were not proof of invincibility. They were the product of a temporary distortion, setting the stage for a sharp reckoning as the true strength of the brand's luxury strategy was put to the test. The last true safety net for Mercedes-Benz vanished with the spin-off of its commercial truck division. In 2021, the board approved the separation, sending Daimler Truck to the stock exchange, and erasing a buffer that had shielded the parent group from volatility in passenger cars. For decades, steady income from trucks and vans had softened the blow of luxury market swings. Now, that ballast was gone. The timing could not have been worse. By early 2025, the van business, one of the few remaining commercial arms, was in freefall. First quarter reports showed van deliveries down 21%, dropping to just 83,000 units. Revenue from vans fell 17%, outpacing even the decline in car sales. With the commercial segment shrinking and no truck profits to offset the pain, Mercedes-Benz was left dangerously exposed. The board's pursuit of pure luxury had stripped away the group's last line of defense, leaving the entire company at the mercy of a market that was no longer guaranteed to buy what Mercedes was selling. The EQS arrived as Mercedes-Benz's answer to the future, a flagship electric sedan engineered with a drag coefficient of just 0.2, the lowest ever claimed by a production car. Executives called it a new benchmark, a rolling statement of aerodynamic mastery in digital luxury. But the market's verdict was swift and unforgiving. Within a year, data from IC Cars and Motor One showed the EQS losing 48.7% of its value, a collapse that left owners staring at resale losses of more than 50,000 euros, sometimes closer to 70,000 euros, before the first lease even ended. Dealers, once eager for allocation, now faced lots crowded with unsold cars sitting for more than 100 days. Mercedes responded with a 30,000 euro price cut, but the damage was done. Buyers who believed they were investing in the next S-Class found themselves holding an asset that depreciated faster than any rival, electric or gas. The promise of exclusivity and enduring value, central to the Mercedes myth, evaporated in real time. The EQS, meant to lead the brand into a new era, instead became a symbol of how quickly confidence in luxury can turn to doubt when reality fails to meet the narrative. AMG once stood as the soul of Mercedes-Benz, a badge that meant thunderous V8 engines, mechanical purity, and a connection between driver and machine that ran deeper than numbers on a spec sheet. That identity fractured with the arrival of the AMG C63 SE Performance. Under the hood, a 2-liter 4-cylinder hybrid, touted for its 671 horsepower, but missing the visceral soundtrack and effortless torque that defined generations of AMG sedans. The backlash was immediate and raw. Enthusiast forums filled with disbelief and anger. Longtime owners questioning whether the brand still understood what made an AMG desirable. Dealer lots reflected the sentiment. C63 hybrids languished unsold, with some US dealers slashing prices by 18,000 euros just to move inventory. The emotional break wasn't just about performance, it was about trust. Buyers who had spent decades associating AMG with a specific kind of joy now saw a product engineered for emissions compliance and marketing spin, not for passion. Reviews called the new C63 clinical, detached, and missing its spark. The decision to abandon the V8 engine for a complex hybrid wasn't just a technical pivot, it was a misreading of what loyalists valued most, exposing a deeper risk to the brand's core. Mercedes had built a reputation on emotion and authenticity. In the silence of the C63, that promise rang hollow. China accounted for 36% of Mercedes-Benz's global sales in 2025, anchoring the company's balance sheet and shaping every major product decision. Then, almost overnight, the foundation cracked. Regulatory filings and company reports confirmed a 19% collapse in China's sales, wiping out nearly 1/5 of the company's largest market in a single year. The timing could not have been worse. While Mercedes was still locked into 4- and 5-year development cycles, Chinese rivals like BYD, NIO, and Xiaomi were refreshing their electric models every 12 to 30 months, pushing out over-the-air upgrades that left legacy platforms looking obsolete. Mercedes' own over-the-air features arrived as afterthoughts, not as the backbone of a modern vehicle. As Chinese brands scaled up, their cadence outpaced Stuttgart at every turn, eroding Mercedes' pricing power and forcing discounting across the portfolio. The luxury narrative that once set Mercedes apart now struggled to survive in a market where speed, software, and relentless innovation dictated who stayed relevant and who fell behind. Mercedes-Benz's board responded to the profit collapse with a set of measures that cut to the bone. 5 billion euros in savings were announced, targeting every layer of the business. Up to 40,000 employees were offered voluntary severance, with some packages exceeding 500,000 euros. The company's annual meeting authorized a buyback of up to 10% of its own shares, an attempt to shore up investor confidence as the free float remained over 70%. But the shareholder map told a different story. BAIC, a Chinese state-owned group, held 9.98%, while Li Shufu, through tenacious prospect, controlled another 9.69%. Meanwhile, United States tariffs on imported Mercedes models jumped to 25% before a partial rollback to 15%, squeezing margins further. In January 2026, Mercedes quietly dropped Level 3 autonomous driving from its flagship S-Class, stripping away a feature once touted as the future. Each move reflected a company fighting for survival, forced to weigh tradition against the demands of a market that no longer played by old rules. Today, Mercedes-Benz stands at a crossroads. Its once unquestioned prestige is undermined by strategic overreach and the harsh math of collapsing margins. As Chinese rivals redefine technological luxury and loyalty waivers, the question is no longer if the brand can recover, but whether its identity can survive. Subscribe for more critical business investigations.